What's up? Today we'll be taking a look at QQQJ, a relatively new ETF from Invesco. This ETF tracks the NASDAQ Next Generation 100 index. So while QQQ tracks the NASDAQ 100 index, the 100 largest non-financial companies listed on the NASDAQ exchange, QQQJ tracks the next 100 largest companies, 101 to 200. So as a result, these end up being largely mid-cap tech growth companies. This ETF gives you the chance to get in on the growth of these companies before they're added to the NASDAQ 100 index. History suggests that 1/3 of Next Gen 100 companies go on to join the NASDAQ 100. But if you do decide to own this ETF, hang on, because so far it has been shown to be 20% more volatile than QQQ. But hey, volatility can provide opportunity. Because of the innovative nature of many of these companies, I think many people may potentially see this as a passive alternative to the ARK funds. But don't get me wrong, I think ARK is great, but again, they are active management, which means higher fees and more taxable events due to the increased buying and selling. Contrast this with a fund like QQQJ, which is passively managed and only rebalanced quarterly and reconstituted annually, meaning less turnover and less occurring taxable events. This gives us a better chance of paying the more favorable long-term capital gains rate as opposed to the higher short-term capital gains rate. Now, because this is still a new ETF, we don't yet have data such as turnover ratio and tax cost ratio. But again, because of the passive management, I would expect these to be pretty low. Also, growth investing tends to be more tax efficient because these companies typically aren't paying much of a dividend, and instead reinvesting back into the growth of their business. And of course, dividends are taxed at ordinary income. This is why some people might focus their taxable accounts on growth investing and focus their value investing in a tax advantage account, such as a Roth IRA or HSA. Anyway, that was a bit of a tangent, so let's get into it and take a look first at the expense ratio. It's 0.15% annually or 15 basis points. This is not too bad. In other words, if you had $1,000 invested, it would cost you about $1.50 per year. So it's not as cheap as some of the other S&P 500 ETFs, but again, it tracks a different index, so it's apples and oranges. The dividend for QQQJ is 0.48, so not much, but again, you don't buy this for the dividend. So let's move on to portfolio composition. 85% of the companies are US based, 80% are mid-cap, 20% are large cap. As far as sector exposure goes, most of it is information technology at 42%. Moving down the line, there's healthcare at 20%, consumer discretionary at 15%, and communication services at 15%. So these are not necessarily all tech companies, but these are companies that use technology to drive innovation, and innovation is what drives growth. More specifically, as far as industry exposure, we have mostly software at 18%. Then moving down the line, semiconductors, healthcare equipment, IT services, also biotechnology, technology hardware, electronic equipment, and pharmaceuticals. Very tech heavy, just like we mentioned before. So let's take a look at some of the current holdings. Just to name a few, we have CrowdStrike, Roku, Garmin, Etsy, AstraZeneca, Trimble, Enphase Energy, Wix, Datadog, Penn National Gaming, and Sunrun. Some of you might recognize a few ARK Invest favorite in there. So far, this ETF has an A rating from FactSet, but no rating is available from Morningstar just yet. As far as returns, we don't have much to go on since it's relatively new. However, backtesting shows some promise. Backtesting QQQJ's index from December 17th, 2010 through September 30th, 2020 indicates returns of 271% compared to 209% for the Russell Midcap Growth Index and 106% for the S&P Midcap 400 Index, respectively. Obviously, past performance is no guarantee of future results, but it certainly gives us an idea. So what are my thoughts? I think it's a great way to get passive low-cost exposure to some innovative mid-cap tech names. It can be a good way to get ahead of the curve by owning these names before they become large caps. I personally dollar cost average into QQQJ and plan on holding for the long term. But keep in mind there's certainly a concentration risk if you choose to own a large percentage of growth tech stocks. Also, these types of companies are very sensitive to interest rate hikes. But of course, none of this is to be considered financial advice. It's for entertainment purposes only. But if you found this helpful, please consider hitting the like button and subscribe for more content like this. Also consider checking out the links below. Down there you can get 2 free stocks with Webull, $30 with M1 Finance, or $10 of free Bitcoin with BlockFi, where you can earn interest on your crypto. Thanks, and I'll see you in the next video.